how could we use that to help these clients offset these rate increases?
And so we're
Yeah.
probably at the end of the high interest rate cycle. We certainly hope.
Most of your money in the stock market keep on doing what it's doing.
Just take a small portion of your investment portfolio and put in something that's going to guarantee a lifetime. Today, we are going to talk about Genworth long-term care policies, mostly legacy policies, and the rate increase situation that's going on with them, and come up with a couple of solutions that might creatively help people deal with these rate increases. Hey, Derek, how's it going?
Hey, Drew, good, good. Yeah, that's a big topic. I get so many phone calls from frustrated clients, saying they get the rate increase letter from Genworth. It really started probably 10 years ago when they really started implementing these rate increases. So, you know, a bit of history about Drew and I. I got into the industry in '99, and we were one of the first companies to get a website up and really kind of move the long-term care insurance buying process virtually. We became a broker and one of the companies early on that had really competitive rates and was the leader at the time was Genworth Financial. So naturally, we have more Genworth clients than anybody. So a lot of our clients are getting hit with these rate increase letters right now.
Yeah, we've got approximately 2,000 policies on the books when we looked at the numbers. And so we've had a lot of calls with clients over the years. This is not a new phenomenon with Genworth, but recently they've been offering some locked-in 5-year rate guarantee options that in some cases, and we should also mention this is not like personal advice for each individual client. Each client's going to have a personal decision to make that we're going to help guide them through. But we're seeing more and more some clients are opting to combine a strategy of taking that 5-year rate guarantee and then repositioning some assets to cover the premium cost. So let's get into that a little bit.
Yeah, so I think I kind of like to nerd out on the interest rates and the economy in general. So if you can just bear with me for a second. So Genworth, when they were creating these products in the early 2000s, mid 2000s, after the financial crisis, everybody remembers once the financial crisis, the housing crisis hit in '08, the Fed dropped interest rates to near zero for 18 years. And so when an insurance company takes your premium, they can't just go put it all in the stock market. The state insurance regulators, based on the company's financial ratings, they force them really to put like usually 80% or so of the premiums they take in bonds. And so when they're putting them in from really 2007 to 2022, they're putting them in at really low rates. When the actuaries were crunching these products, creating these products in the late '90s, looking at risk, like long-term care risk in combination with interest rate risk, they really underestimated the interest rate risk. And so when they started getting higher claims and couple that with low interest rates for 15 years, that's when they started to do these rate increases. So that's really where a lot of these rate increases came from. Drew and I were just kind of just talking the other day, and we're getting a lot of these calls. Where's the opportunity? There's always an opportunity in life. You just got to be creative enough to find it. And the opportunity here was, yes, your rates are going up, but what else has gone up? Interest rates. So now, the CDs that were paying 1%, just 3 years ago, now we're paying 4, 5, 6%. And there's these fixed index annuities that you could turn a lifetime income stream. They're paying anywhere from 8% compound to 10% simple, guaranteed each year for the next 20 years. So we started thinking, how could we use that to help these clients offset these rate increases?
Right. So they can lock in these high interest rates on an annuity. And if you go back and look at our channel from 5 years ago, we were not talking about annuities because at the time they weren't competitive. They
That's right.
are competitive today. So it's something that we've become a lot more keen on advising clients take a look at because these high interest rates are probably a flash in the pan. I mean, I would just pull up the chart. Typically, when rates go this high, they don't stay this high for very long if you look at the last 25 years. And so we're
Yeah.
probably at the end of the high interest rate cycle. We certainly hope. And it's an opportunity to lock in. And so that's what we wanted to discuss. Specifically, let's get tactical. So, you mentioned 8% compound, 10% simple. What does that mean? Let's explain to our viewers what exactly we're talking about there.
Yeah, so there's a lot of viewers out there who already have existing annuities. They have products they bought really from 2008 to 2022. If you have an existing annuity, whether it's from a job, from a broker, you really want to check it out and see what the details are, because there's a very good chance, just like when everybody's refinancing their mortgage a few years ago when interest rates were 3% to get a 30-year fixed rate, now people can refinance their old annuities that were in low interest rates. And to your point, Drew, lock him in at the all-time high. I got a real life example. So I have a lady who called me the other day. She bought her Genworth policy through LTC Tree probably 10 years ago, possibly 15. I couldn't find the exact age of it. It was before we moved to the new CRM. But she basically, her premium's going up from $500 a month to about $700 a month. So that's a 40% increase. And so Genworth is giving her the option to keep her premium the same, but to reduce her future inflation protection from 3% to 1%. And then it'd give a 5-year rate guarantee. So she really wanted to keep her premium the same. So we just got to talking, and I told her this strategy that we're using, how you could just use a portion of a fixed asset to basically create a lifetime income stream that then could be used to pay this long-term care premium. So in her case, she had $750,000. I think it was Great West annuity in 2018, which is a good company. We love Great West, great company. But the annuity was built in 2018 pricing. So if you brought that chart up earlier, Drew, it's churning off a lifetime income for her right now. But we just crunched some numbers with some current companies, and she's going to increase her guaranteed lifetime payment by her monthly income coming in by 16% simply from just refinancing her old annuity. And that more than offsets the Genworth premium. So essentially, she's going to be able to just refinance her old annuity and have more money coming in than she was. It'll pay her whole entire Genworth policy by really just changing names at the top of a statement.
Yeah. So when life gives you a lemon, in this case, high interest rates, you make lemonade, which is refinance existing annuity money, or perhaps take a few chips off the table as we approach all-time highs in the stock market, and just take a small portion of your investment portfolio and put in something that's going to guarantee a lifetime income. So a lot of options. And it's really something that is thrilling our clients. And that's why we wanted to talk about it, because, when we first begin this conversation, it's like, yeah, this stinks that they're raising these rates and here's why they're having to do it. But like you said, we've found an opportunity that offsets it using the same macroeconomic principles.
Yeah, it's guaranteed lifetime income stream. So it's not something that may or may not. This is guaranteed.
Yep.
You put in X number of dollars, and it doesn't have to be just from an old annuity. It could be from a low-paying CD or money market fund or low-paying bond funds. We love the stock market. We advise keep most of your money in the stock market, keep on doing what it's doing. But like you said, take some chips off the table. Maybe go after the low-paying bond funds or annuity. Those fixed assets, if you put them in this, it's going to guarantee you, no matter how long you live, X number of dollars for the rest of your life. And it doesn't have to be a whole lot. It could be as little as $50,000. In this case, she's looking at $750,000 because she wants, a bigger retirement income. So it was just one strategy we thought of, and it's something that's, in my opinion, is probably going to continue in that traditional long-term care space is rate increases. So we wanted to just hop on today and give some ideas on how to offset it.
Yeah. So there's probably a lot of people out there that are dealing with, we know, having thousands of these customers that are dealing with, what do I do? And a lot of these clients may not have us as their agent. They may have had an older agent who's already retired. Feel free to give us a call, and we'll just have a quick, frank conversation and help advise you on, what your options are, A, B, the pros and cons of different solutions. And then we can talk about this way of offsetting this rate increase using the current high interest rate to your advantage.
Yeah. And so a lot of times when life presents you with a challenge, the easy thing to do is get the statement, oh, this is too hard. I don't want to go through the process of doing it. But if you don't take action, nothing's going to change. And so it's like, what's the source of results in the world? It's action. And it's not a big action. You just got to pick up the phone, call us. And the action on your part would be, if we do find an opportunity, and there's no guarantees we'll be able to save you money or get you a higher interest rate. But if we can, it's probably a 10-minute e-application, and that's it. We take care of the rest. So if you'd like to learn more about any of these long-term care insurance products, hybrid long-term care insurance products, long-term care insurance, or these lifetime equity index annuities, give us a call.
Yeah, we'll put the number on the screen. And we've been doing this for literally decades at this point. And
I can't believe it. Yeah.
yeah, it's funny because when we first got into the business, we were disrupting the industry, and now we're the old salts.
I know.
But
And
I
there's
kind
probably
of
gonna be
like
some young bucks going to be disrupting us if we don't
exactly.
stay on our
Well, we
toes.
try to keep up with the trends. That's why we're here on
Yeah.
YouTube, and we appreciate y'all watching. So we'll wrap this up. We wanted to tell the story. We wanted to explain the concept. Derek, kudos for taking an incoming call and turning it into an opportunity that's going to more than pay for her long-term care with a 10-minute phone call. That's pretty cool.
Yeah, yeah, exactly. And there's no guarantees we'll be able to do it for you, but it's at least worth it, worth a conversation. So if you'd like to learn more, fill out the form on their site or call us. Odds are Drew or I or our assistants will pick up.
Alrighty, man. We'll catch you later on.